let's start.
Yes, sir.
Let's start our discussion with a P&L question, which was asked in September 2020. Unlike balance sheet, so P&L questions, as I said, are a little easier. The simple reason is there are no two effects of it, and generally it is easier for us to read that adjustment and then just give the impact immediately. So it also requires little less time than the balance sheet question. Let's do this question from September 2020. Alpha, a parent company with one subsidiary, Beta, is preparing the consolidated statements of profit and loss and other comprehensive income for the year ending 31st March 20x5. This December 21 also they had asked a question on P&L. So there was a trend when they used to ask a question on P&L in June, and subsequently in December they used to ask a question on balance sheet, but this trend has now changed again. There is no fixed trend which you will find that they will ask for June, they will ask P&L and then balance sheet, nothing like that. So we have to prepare for both. So you can actually make little judgment, but not while preparing. While getting into an examination, that's okay, but otherwise no. So this is for the year ending 31st March 20x5. Revenue is given for alpha and beta. There is note number 2 on that. Cost of sales. There is note number 2 and 4. Gross profit, distribution of cost. You can easily make out this is presentation of expenses by function. Administrative expenses are there. Investment income is there. Note 1 and 3. Finance cost is there. Profit before tax, income tax expense, profit for the year after tax. Other comprehensive income items that will not be classified through P&L. Other comprehensive income for the year. Total comprehensive income. And then notes. The drawback of P&L question, or I would say even a positive of this question, is you do not understand whether we are going wrong or right. So this doesn't affect our morale at all. At least in balance sheet, my balance sheet is not getting tallied. You have made something wrong somewhere. In some of the working notes, you have not given two effects, whatever it is. P&L, there is no scope of identifying whether you have done any mistake or not. So that way, it has both pros and cons. You don't get confidence, but even you don't lose morale to that extent. During examination, doesn't make any difference. You can solve the rest of the question paper easily without keeping anything at the back of your head, which doesn't go with the balance sheet. On April 1st, 2000X3, Alpha acquired 180 million equity shares in Beta. On 1st April X3, Alpha acquired 180 million equity shares in Beta. So date of acquisition is 1st April 20X3. On that date, Beta had 200 million equity shares. There is no balance sheet. You don't have to go up and check. So they have given it. So it's straight away 90% of the share. Okay. Alpha made a cash payment of 60 million to the former shareholders. 60 million cash payment on 1st April 20X3 and agreed to make a further payment of, so there is a contingent payment, and agreed to make a further payment of 26.62 million on 31st March 20X6. Sorry. Alpha had correctly accounted for the deferred payment in its financial statements for the year ended 31st March 20X4. But has made no further entries in the financial statements for the year ended 31st March 20X5. When this was promised 1st April 20X3, am I right? We are on 20X5. So after 2 years, we are there. What could be the impact of this? Can you tell me? What could be the impact of this deferred payment? This is not a contingent payment. This is a fixed further payment. This is a deferred payment. What this will have impact on our financial statements, not on P&L, I'm asking, on our financial statements. Anyone?
Liability.
Correct. You will create a liability. You are absolutely right. That liability will be at what amount?
Present value.
Present value. I don't require an amount. That's okay. So you will make that as at a present value. But what that will have impact on 31st March 2025? That's my question.
It will be unwounded.
It will be unwinded. Absolutely right. So by unwinding, it will have impact of interest expenditure. Am I right? So interest expenditure is a part of the profit and loss account. So you have to think. So this is a question of P&L. If they have not made that entry, you will have to make that entry. Next, an appropriate annual rate of discounting. They have given 10%. They have also given the present valuation factor. You don't have to do it on your own. On 31st December 2024, Beta paid a dividend of $5 million. Beta paid a dividend of $5 million. This was the only dividend paid by Beta in the year ended 31st March 2025 and was appropriately recognized by Alpha. So Beta paid a 5 million dividend. How much Alpha would have received? 90% of it, absolutely right. So we will have to eliminate that from our profit and loss. Correct? Then on 1st April 2023, Alpha made a long-term loan to Beta of $25 million. So the loan so it's an intercompany loan, but are we doing any kind of a balance sheet? No. So elimination of intercompany balances, transaction elimination doesn't arise in this transaction, but what it will have impact. Let's read. The loans are included in the financial statements of Beta at this amount. This long-term loan attracts an interest at an annual rate of 8%. So both Alpha and Beta have correctly accounted for this interest in the financial statements for the year ended 31st March 2025. So it means the interest income of Alpha should be reduced and interest expense of Beta should be eliminated upon consolidation. So there are 3 adjustments in note 1. They are saying no impairment of the goodwill on acquisition of Beta. So you don't have to calculate goodwill at all. There is no such information where you can actually calculate goodwill. So you are not required to do that. First adjustment has 3 effects. 1 is unwinding of interest, elimination of a dividend, and 3rd is elimination of interest income and expenditure. That's it. Intra-group trading. Alpha, this is very important adjustment, and this invariably comes in any type of P&L related question. In P&L, this adjustment will be there invariably. I will read that adjustment and I will explain. Alpha supplies Beta with a raw material. Who is supplying to whom? Parent is supplying to subsidiary. Who has made the profits? Alpha has made the profits. Whose inventory it will have unrealized profit? Beta's inventory. Alpha supplies Beta raw material which it uses in its production function. Alpha applies markup of 1/3 of its cost. 1/3 of its cost. So markup is 1/3. So 3 cost, 1 profit. So total 4. Correct. So if you would like to reduce it, so 1/4 reduce it from the cost. So total amount, it will be at the cost. 1/3 of its cost. The sales of a raw material for Alpha to Beta in the year 31st March 2025 total 10 million. So revenue of Alpha included 10 million, cost of Beta included 10 million. Eliminated that entirely. So one adjustment will be in revenue, less 10 million. One adjustment in COGS, reduce 10 million. Another point, on 31st March 20x4 previous year and 31st March 20x5, the inventories of Beta included goods costing 2 million and 3 million respectively. So this inventory of Beta included goods costing 2 million with this profit in them. No, I can understand 20x5, right? What will you do in 20x5 to eliminate the profit? Am I right? So if you calculate so you have reduced revenue, you have reduced cost of sales, you will reduce unrealized profit on inventory, you will reduce inventory, but at the same time, you will reduce the profit of alpha. Am I right? Everybody, Yogesh, are you with me? Okay. So if you reduce the profit, if you reduce the inventory of beta, you will also reduce unrealized profit from the profits of alpha. I can understand this for 2005. Why something is given for 2004?
Opening stock.
Opening stock, but there is no opening stock with us right now. What we will do with that? I will tell you, this is very important. Remember this, okay? I will explain you the logic. So this year's profit, unrealized profit on inventory, you are reducing it, you are eliminating that. So your profitability will be lower. Same adjustment you would have done in the previous year also for the stock of the previous year. Am I right? Everybody, the same profit this year that entity would have realized. Am I right? That profit you will have to increase in the current year's profit and loss. Are you getting this point? And that's why this adjustment is given. Generally, what we do as a year-end adjustment, you eliminate and subsequently you reverse those accounting entries. What do you do by reversing it? Because you reverse it, that profitability which you cancelled on an inventory in a subsequent year, group as a whole, you would have sold that inventory and earned that profit. Now that profit would have realized, so you should recognize that there is nothing unrealized from a group standpoint, and that's why the profit which has been eliminated previously because it was within group, now it is outside group, you will have to recognize that profit. So previous year's profitability, you will have to increase the profit, that is reduce the cost. Increase the profit means reduce the cost, correct? Where this adjustment would be, this adjustment is in the cost of goods sold. So this is purchases, so this would be in cost of goods sold. So this year's cost of goods sold will increase, and previous year's cost of goods sold, because of that, that profitability will increase and cost will reduce. So we'll have to remember this adjustment. Is everyone with me now? Okay. So this is 1/3 of cost. So 1/4 of selling price. This is for 2004, 31st March 2004, and this is 3 million is for 2005. For 2005, it's 3 million, and for 2004, it is 2 million. Apart from its investments in equity shares, now adjustment number 4. So adjustment number 2 will have two things: elimination of transaction and elimination of unrealized profit, current year and previous year's reversal of that. Apart from its investments in equity shares and loans to beta, Alpha has a portfolio of equity investment which are correctly classified as FVTPL. Investments of Alpha for the year ended 31st March 2025 currently correctly includes dividend income from its portfolio. However, carrying amount of the portfolio has not been adjusted to its fair value at 31st March 2025. On 31st March 2025, the carrying value of the portfolio is $32 million vis-a-vis its fair value at $33.5 million. So what do we need to do here? Yogesh, what do we need to do here? Babita, Dipali. What they are saying, they have an investment portfolio apart from investments in beta. Am I right? You're here till this point of time. They also have other investments with them in their balance sheet. Those investments are accounted for as FVTPL. Are you getting my point? I mean, whatever return I am telling you. So ideally, what should be the adjustment? Every reporting date, those investments should be fair valued, which are classified under FVTPL. Gain and loss should be taken to the P&L, correct? They have not taken it for this year. So what you will have to do? You will have to take this gain or loss to P&L, correct? Yes or no?
Yes, sir.
So you have to just take it to the P&L. So this difference between 32 and 33.5, it's 1.5 million. You will have to take this to profit and loss account. Investment income. Revaluation of property, plant and equipment. There are only two more adjustments. Both alpha and beta measure their PP using revaluation model. PP is measured at the end of each financial year. In previous periods, Alpha has recorded net revaluation losses of 3.5 million. Where this would have been accounted for. The losses were accounted for correctly as per IAS 16. It means what? Where they would have accounted for.
Revaluation reserve.
Revaluation reserve. Okay. Any other answer?
Loss is
Sir,
to gain. Gain is to revaluation reserve.
Gain to the revaluation reserve, losses to profit and loss account. You forgot that. Losses, if those are first time recorded, those will be recorded to P&L. But if there are any gains previously, then I can recognize it to OCI, but otherwise no. Losses to P&L. So these losses were recorded to P&L earlier. But then subsequently what happened? In the financial year, Alpha for the year ended 31st March 2025, remeasurement gains of 5 million were entirely recognized in OCI. Earlier, now what will happen with this 5 million gain, remeasurement gain? This is for 31st March 2025. What will you do?
3 point. So we'll adjust.
Go ahead, Babita.
So first we'll adjust the 3.5 million.
Okay.
And then
so
balance
to adjust that, where I'll have to account for it.
Profit and loss.
Okay. So this gain, Yogesh, of 5 million, out of which 3.5 for earlier years you have transferred it to P&L, you will credit this 3.5 million to P&L, and balance I will credit it to other comprehensive income, revaluation reserve, correct? So these were entirely recognized in other comprehensive income. Is it correct? So in 31st March 2025, remeasurement gains of 5 million were entirely recognized in comprehensive income, other comprehensive income. Is it right? Shiva?
No.
Only 3.5 need to be recognized.
Exactly. So this is wrong. So in this examination, they will give you wrong treatments which they have followed earlier. You'll have to rectify that. If you do not understand there is an error, you will not be able to rectify. And if you will not be able to rectify, you lose marks here. So what is adjustment is whatever is the revaluation, there are other comprehensive income you can see. So there is other comprehensive income. See this gains on property revaluation. How much is that? This is 5 million. Correct? This 5 million is recognized exactly this 5 million. It's entirely this year's gain. But is it correct? No. So this 5 million should have been only 1.5 million because balance 3.5 should have been part of retained earnings. Correct? So you have to make this adjustment. Last point. so if you read further, this gains related to same properties were had previously suffered the revaluation loss. So these are the same properties. You cannot adjust gains of other properties to these losses. Correct? Beta has only ever recorded revaluation gains. All depreciation and so beta has only ever recorded the gains. So it means all losses were recorded to P&L earlier. So this gain must be recorded to the P&L first to the extent of earlier losses, and subsequent gains will be transferred to other comprehensive income. Then all depreciation and impairment of PP are recognized in the cost of sales. So in the cost of sales, you will have to adjust this, not retained earnings. I'm sorry, I mistakenly said retained earnings. Note number 5, equity settled share-based payment scheme. Now, if you have done IFRS 2, you will be able to execute this appropriately. What it says? It says that on 1st April 20X3, Alpha granted 50,000 senior executives, 500 senior executives, 4,000 share options each. The options vest on 31st March 20X7. The options only vest for the senior executives who remain employed. So there is only service condition with respect to this. On 31st March 20X7. So what is the vesting period? How much is the vesting period?
4 years.
4 years.
4 years, simple. Following information is provided on 1st April, 31st March X4, 31st March X5. They have given fair value of the option. They have also provided the options expected to vest. The transaction was correctly accounted for in the financial statements of Alpha for the year ended 31st March 20X4, and cost was recognized as an administrative expense. However, no further entries have been made for 20X5. So you have to make that entry and account for it accordingly. Prepare consolidated statement of profit and loss and other comprehensive income of Alpha for the year ended 31st March 20X5. Where relevant, you should round off all the figures to the nearest 1,000. Okay, so this is with reference to, probably you will get a odd figure here. Here you will get some kind of an odd figure, so you have to round it off. They have clearly mentioned round it off to the nearest 1,000. So I mean, it's very simple. Let's start doing this. Books of Alpha. Statement of P&L and other comprehensive income for the year end. What is the year end here? 30th September, 31st March 20X5. This also has similar kind of an approach we'll have to follow. We'll have to prepare profit and loss account statement, structure of the statement, P&L statement and OCI, and then create working notes for all these, and then read the adjustment, and then accordingly do the postings. So we will prepare particulars, note, amount USD 1,000. You have structure in front of you, just write it down without amounts. Revenue. Revenue, cost of goods, cost of sales. Then you have a gross profit. Then you have distribution cost. Then you have administrative cost. Distribution cost, administrative expenses. You have investment income. Then you have finance costs. Then profit before tax, tax expense, profit for the year. Other comprehensive income. Items that will not be classified to P&L. This will have revaluation reserve. This will have revaluation reserve. Then you have total this is total other comprehensive. Then you have total comprehensive income. Total comprehensive income is comprised of profit plus OCI. And then you will have to allocate, okay? Allocable to owners of parent, %90, and balance to NCI 10%. Once you do this, then your working note starts. First is revenue. So whatever we had posted here, we will have notes for that. Cost of goods sold, we have adjustment for that. Revenue, we have only one adjustment, but cost of sales has 2-3 adjustments. So leave 3-4 lines there. Distribution cost, there is no adjustment. Administrative cost is there because share-based payment expenses you are going to account for in administrative cost. Distribution cost will write directly there. Only one adjustment in the administrative cost as such. Then I have fourth is investment income. Five. Investment income, then finance cost. Finance cost, we have adjustment there. Then income tax expense, we do not have any adjustment. Then revaluation. Or I would say other comprehensive income. You also have adjustment for share-based payments and deferred payment. That also you'll have to do. First is related to deferred payment. Interest expenditure. on deferred payments, then you have share-based payment expenses. Share-based payment expenses. I think this is the last one. Okay. This is equity settled, so we'll have to consider this as well. Let's post the amounts here. Revenue. Revenue, we'll have the adjustment here on revenue. So 64,800 plus 39,000. Cost of goods sold, same, we will have adjustment here. So 26,000 plus 16,000. Sorry. You have to take care of and think of the signs, mathematical signs here. Okay, so cost is negative and revenue is positive. So while adding, deleting, you'll have to remember that. So this is cost of sales. Then distribution cost, there is no adjustment. I will add it directly in the P&L. Distribution cost is 5,000 plus 2,000. We'll see about the how do we manage about the mathematical signs at a later point. Then administrative expenses. We have adjustment here, administrative expenses, 9 plus 3,000. Investment.
So 3,500.
Oh, 3,500. Thank you. 3,500. Investment income is 7,000. Finance cost is 4,000 plus 2,500. Then income tax expenditure. There is no adjustment in income tax expenditure. I will add directly like this. Tax expense. 7,000 plus 4,000. So all amounts are accounted for. Now gain on revaluation, property revaluation, 5 plus 8. 5 plus 3. 5 plus 3, 8,000. Comprehensive income for the year. So we will consider that. Now let's read adjustments one by one. Alpha acquired 90% of the stake. They paid 60 million cash and deferred payment of 26.62. So there is first an adjustment of deferred payment here. Present value. Deferred consideration. Present value of deferred consideration. What is the present value of deferred consideration? It is USD 26.62 million multiplied by 0.7513. If we do this, what is the amount? 26,062. In thousands, if we do this, 2662 multiplied by 0.7513, it's 20,000. It's 20,000, correct? So this is when 20x3, 1st April 20x3, you will have to do it for 31st March 20x4 and then x5. X4 they have accounted it correctly. So add interest expenditure for the year 20x4 multiplied by 10%. So your opening balance as on 1st April 20x4 is this. Add interest expense for the year 20x5. This amount we need. You will not do anything with the by adding this up in 22,000. You will not do anything. So we are anyways calculating only this impact. So where this should go? This is interest expenditure, where it should go?
Finance cost.
Finance cost. Add interest expenditure on deferred payment. This is number 7 working note. One effect, and otherwise that liability will increase and it will be shown in the liability side. Next, dividend. Dividend has been declared 5 million. So that dividend declared must have been accounted for in investment income. Am I right? That income should now be eliminated because beta has now been consolidated. Correct? So it's one of the same company. I cannot have income. There will be NCI portion which will remain. I don't have to cancel that because that has been taken by outsiders already. But for alpha, what alpha has received, that has to be cancelled out. So less dividend received from beta. This is reduction. Finance cost has been increased, so it must be a positive value. This is a negative value because this is income and you have to reduce it, so it should be negative. So we have to be a little careful about the signs. Okay. Next is alpha made a long-term loan to beta for 25 million. So we are not going to cancel the loan because we are not preparing balance sheet. So 25 million multiplied by 8% must be in an investment income of alpha. So reduce interest income of alpha on loan to beta. This is multiplied by 8%. And this should also be reduced from the finance cost of beta. Correct? interest expense of beta on loan from alpha. Same calculation. But this finance cost is reducing, so it will have a negative sign. Then okay, now intra-group transactions. So there is 10 million of revenue and cost of sales. Reduce that. Less intercompany transaction. $10 million, so 10,000. I'll have to reduce it from here as well. Correct. Cost I had considered in this cost of 42,000, but I have to reduce cost, so amount should be negative only. Correct. Then there is a cost, the unrealized profit, elimination of unrealized profit. So that unrealized profit of March 20x4 should be increased because I have cancelled that in the previous year. So I should include it in the profitability of this year. So my cost of sales should reduce. Correct? Cost of sales should be reduced. So less unrealized profit of 20x4. How you will calculate that? How much is the amount? 2 million and 1/4 of that. So 2000 multiplied by 1 divided by 4. So it is 500. Why reduction? Why reduction? Because you are reducing cost. You are recognizing profit which was cancelled in the previous year. Now you are recognizing profit, in the sense reducing cost. Am I right? And this is cost of sales. This is cost. This is profit. So cost should be reduced by the profit recognition. For the current year, I am reducing the profit. I am cancelling the profit. So I'll have to increase the cost. So add unrealized profit of 20x5. How you will calculate this? It's the amount is 3,000. 1 divided by 4. Have you understood 1 divided by 4? Everybody? Huh? Yogesh? Mansi, Babita, Deepali. Have you understood why 1/4?
Yes, sir.
Yogesh, you didn't understand this? You should have asked, right? Huh?
Yeah, I'm reading the question, that specific note.
No, unrealized profit, we had discussed about this. What they are saying, it's a markup of 1/3 to its cost. So if 1/3 of cost, in the sense what? I have 3 portions of cost and 1 portion of profit. So total becomes 4. Am I right? So if I would like to reduce this unrealized profit, this profit is 1 out of 4, and that's why 1/4. Correct?
Yes, sir.
So let's say 3 is cost, One is margin, and this is total. Now this is inventory is reflected at 4. If I would like to reduce the margin, it is 1/4. 1 out of this 4. Okay, and that's why this is 1/4.
Yes, understood.
Okay. So this is 3,000 multiplied by 1/4. I am increasing the cost, eliminating the profit in the sense increasing the cost, correct? Now, I have given effect here. Okay. Now, number 3, fair value adjustment. I have to do this fair value adjustment for 1.5 million, where I have to give this investment income. I have to increase this investment income. Adjustment of fair value gain for 20x5. This is 1,500. Income will increase, correct? Number 4, revaluation reserve. I have revaluation reserve recognized here of total 5,000 plus 3,000, out of which 3,500 should be recognized in cost of sales. So that is what they have written, correct? Cost of sales. They have recognized revaluation gain, depreciation, everything in the cost of sales. So this adjustment is in cost of sales. So other comprehensive income, it should not have credited entirely to other comprehensive income. That's the wrong treatment they have given. Am I right? Everyone? So wrong treatment, what correction I should do? Less revaluation gain to be credited to P&L to the extent of earlier years losses debited to P&L. You write this entirely. You need not write the entire note per se. Separate note you are not required to write. So less 3,500. But where this should go? This should reduce my cost of sales. Cost of sales. Less revaluation gains. Correct? Minus 3,500. This is note number 6. Okay. Now, so we have accounted for this as well. Now, equity settled share-based payment transaction. We will come to the share-based payment related note. What they have given, we'll have to find out a charge for the first year. Then we are into second year. They have granted it into 20x3. So the first year will get over in 20x4. Second year will get over in 20x5. We are on 20x5. So to find out a charge of 20x5, unless and until we calculate the charge, what they have done into 20x4, we will not be able to find that amount, calculate that amount. In order to calculate that, we'll calculate here charge of share-based payments for 20x4. What do I need to do? Can you tell me? First, tell me the formula. I mean, formula in the sense logical. Or you have forgot everything about share-based payment.
Find out the total options.
Total options outstanding multiplied by
fair value of the grant date.
multiplied by
1.20.
grant date fair value of option multiplied by
Percentage of
percentage
Yeah, percentage.
expected to waste. Correct? So this is what you will have to calculate. What are the total options outstanding? Can you tell me? Total options outstanding.
4,000.
1,000 into 400.
4,000 into grant date fair value. We are on 31st March 20 export. So the fair value of
1.35.
135 should be considered, correct?
Yes.
Okay.
So
Any other
1.2.
1.2. Deepali, why 1.35? Deepali?
Because we calculating at like 31st March 2004.
But when we have discussed that this is equity settled share base, I have highlighted
Oh,
it.
yes, it will not change. Correct. Sorry.
Good that you have made a mistake. You will not forget now. This is 1.20. If had it been cash settled, then your answer is correct. If it is a cash settled, this is not cash settled. This is equity settled, so this will not change. Multiplied by how many are expected to waste? Now this must be 400, correct? Whatever we have considered on the grant date, that we'll have to consider.
It's 420.
400. Everybody agrees?
No, 420.
420.
420.
So this should be 420 because this will keep on changing every time. Okay. So this will keep on changing, and this is the total charge for the 4 years. So you will have to do it for 1 year multiplied by 1 divided by 4. So this will be charge for the first year. 4,000 multiplied by 1.20 multiplied by 420 multiplied by 1 divided by 4. So this has to be in 1,000. All right. Because we are doing it in 1,000. 504. Now charge for for 2000 x5. This will remain same. So we will change this a bit. Change in the sense we will complete this formula. We had written it half. So this is multiplied by 1 divided by 4. Sorry. We will use the same formula. Less amount expensed in previous year. This should be multiplied by 2 by 4 because we're in the second year now. This is 2 by 4.
Sir, it should be 450, right?
Correct. This should be 450 because this will change. This will change to 450 multiplied by 2 by 4 minus 504. Is this the correct answer? These are the benefits of Excel. You don't have to use calculator much. You write the formulas and then again you have to use it just like this. So simple. This is the expenditure which you will have to account for. Where you will account for this 576? They have said administrative cost. So here add share-based payment expenses. $576. We have done everything. So we just have to do the totaling here now. We have to be careful while doing that. My revenue is 93,800. Now cost of sales, this is cost intercompany transaction. I have reduced it. Unrealized profit of previous year, I have reduced the cost. Current year, I have increased the cost. Revaluation gain, I have reduced the cost. Correct. So 28,750. Then administrative cost is 13,076. Investment income is 2,000. Finance cost is 6,700. Other comprehensive income is 4,500. This we have already used it. Share-based payment we have already used it. So other comprehensive income, we have to adjust this revenue. So this is in note number 1, 93,800. Note number 1, cost of sales. Note number 2. Note number 2. Now this is cost of sales. Let's make it minus and this. So it will give us the gross profit. 65,050. Actually, we do not have any scope to check whether this answer is correct or not. It's just that I have answer from the examination answers, so I can tell you whether this is right or wrong. This is correct as far as what we have done. Then distribution cost, I will make it negative. Again, this is cost. Administrative expenses, again, we have separate note for it. Note number 3. Note number 4 and 5. Investment income will be positive. Finance cost will again be negative. Sorry. Now, you will have to calculate the net profit. So out of this, this is the total one. My mouse is giving me really problems. I don't know where I've kept my mouse pad. Okay. Now these are the costs. So you can calculate profit before tax as this plus this is 40,274. Then the tax expense, profit for the here after tax is this minus this 29,274. Revaluation reserve, you can take this note 4,500. Note number 6. Your total comprehensive income is this profit plus other comprehensive income 33,770. Till this point you are done. Your P&L problem is actually over. Your P&L problem is actually over. However, this adjustment is one of the most important adjustments. This adjustment is one of the most important adjustment. If you make mistake here, then you will tend to lose marks. Whatever the stepwise marks you will get those marks. But this is important. Can you allocate this and tell me what is allocable to owners and what is allocable to NCI? Anyone? And then this total would be plus this. Ideally, this should be equal to 33,774. Correct? So what is this amount and what is this amount? Yeah, Deepa. Any answer?
90 and 10% only.
Sorry?
So 90 and 10% respectively.
90 and 10% respectively. So you mean this multiplied by 90% and this multiplied by 10%. Correct?
Yes.
And this would be 33,774. Is everybody with her what she's saying? No? Why, Sonal?
So because parents' profit is allocated only to parents, there is no
You
NCI
are
in that.
absolutely right. So Deepa, you have to be very careful here. If you see this profit, which is this profit, 33,774, it contains the profitability. See this profit, this 25,800 and 14,000, and with some intercompany eliminations. After that, so this 33,774 contains profit of alpha. Now with your kind of percentage, you have allocated NCI to NCI the profitability of alpha as well. Is it right?
Okay. Yes.
You can't allocate NCI profit of alpha. Alpha's profit is 100% that of alpha, and only beta's profit you will have to allocate it to the NCI. Am I right? So what you have to do here is make another note. Allocation of total comprehensive income to owners of parent and to NCI. Allocation of total comprehensive income of beta. This is important. Of beta. What is total comprehensive income of beta? This 11,000 is the profit for the year, and then 3,000 is the OCI. My total income is of beta is 14,000. Am I right? Everybody agrees?
Yes.
Huh?
Yes.
So only this has to be allocated. Now see this, there is, fortunately or unfortunately, there is no adjustment which we have done for the beta's profitability. In our example, for profit elimination of on unrealized profit on inventory, who has earned that profit? Alpha earned that profit. So we have cancelled or we have eliminated profit of alpha. Am I right?
Yes.
Had it been sold by beta, we would have adjusted that in this 11,000. Am I right?
Yes. Agreed.
So before allocation, I would have adjusted this 11,000 for that unrealized profit elimination entry, which in this current question, it is not there. In addition to this, let's say, had there been any goodwill impairment also one portion goes to NCI. If you remember about our first question, this is our first question. In first question, NCI had two adjustments, impairment loss and the post-acquisition loss. But in this case, let's say there is no such kind of adjustment, and there is, let's say, profit elimination adjustment is also not there. In this case also, there is profit earned by whom? It's earned by the subsidiary, and then it gets allocated to NCI. It gets allocated to NCI. These kind of adjustments are not there. These kind of adjustments are not there. Had it been there, I would have adjusted this 1400 here first, but here there is no adjustment, so it is 14,000. Otherwise, I would have adjusted those NCI adjustments here, and then I would have allocated that profit. But here there are no such adjustments, and that's why what I will do, this 14,000. So any which ways I'm allocating the profit. But if before that, had there been any elimination of profit on inventory, unrealized profit on inventory, I would have adjusted it here. Had there been any impairment loss to the extent of NCI, I would have adjusted it here, and then I would have allocated this. So now this is equal to this multiplied by 90%, and this is multiplied by 10%. 1,200, 12,600 and 1,400. So you write note number 9. So to NCI, it is 1,400. NCI, it is 1,400. And rest is allocatable to this. Sorry. $32,374 and 1,400. Any questions you have?
No, sir.
So I have one query.
Yes.
Sir, do we have to mention that percentage over there while presenting it here?
Yeah, why not? So it's not
Because-
directly applicable to this. So don't worry, we are preparing a separate working note for that. So it's not working note number 9, it's a balancing amount here. All right. Even if you don't give the percentage, that's okay. It's not necessary. So this is full-fledged P&L question. Quite quickly we were able to do it. About 1 hour, 10 minutes, approximately 1 hour, 15 minutes, not more than that. So this question, you need to understand what kind of different adjustments will be asked. Go through the various types. I have also a couple of more questions solved. Those are on YouTube. Go through them, and then you will be able to understand. Okay.
Here in OCI, do we have to write revaluation reserve or gain on revaluation?
Gain on revaluation. I might have made a mistake while writing this, so you can say this as gain on revaluation. Here, gain on revaluation. Okay, any other question? Okay, I have not done any kind of a formatting which you are not required to do in examination, even if you do not do this bold, etc. But making it, few line items as bold, it actually catches the, attention. So for important line items, important figures, you should do this. Otherwise, absolutely no formatting is required here. Okay. This is how we have come to an end of the entire session, entire batch. We started it 3 months back in January, and you are few people who had patience to stay back till end. I appreciate your efforts and commitment and patience as well. Similar patience you have to show till the end of examination gets over on 10th or 11th of June. I am very sure that if you do not take it lightly for the remaining period, because there is a sufficient amount of time, we are towards end of March, there is still April and May, 2 months remaining. So you can do significantly over this 2 months. Okay. Any queries during the study, you can definitely reach out to me on a WhatsApp, not an issue. And if the queries are lengthy, you can send me a WhatsApp on a voice recording, and then I will go through that and I will reply you back. That's not an issue. And there is a query resolution session on 25th of April. If you would like to join, you can join. So you can talk to Amruta, Ashwini, you can register for the query resolution session. Of course, you just have to register it. There is no fee for the query resolution session. It's just that we should be aware that how many people are joining, and that's why we have kept it as a registration. That is mainly for the people who have not been there live online with me. They are using entirely the pen drive. But if you have any questions to be discussed with me, you can send those to me in advance in an Excel sheet, and you can join that query resolution session. That's not, it's not that you cannot join. So please feel free to join that session and do a good revision. If you wish to join the revision batch, which is starting during May, you may join. It's definitely, it's up to your decision. It's up to your discretion. If you like to join, you can join. Otherwise, you can study on your own and do best for your examinations. Wish you all the best. And most importantly, not the least, I would request all of you, if you have found this useful, these sessions, and interactive and helpful for the examination, I would request to drop spare 5 minutes and give your review on a Google. So I will ask Amruta or Ashwini to send you the link, and just drop a review, very short review, 3-4 lines, 5 lines, 6 lines, whatever you feel about us. You can mention that. If you find it good, then other people should get benefit of it. With Google reviews, more and more people will be reached. So thank you so much.
Thank you, sir.
Wish you all the best.
Thank you.
Thank you.
Thank you
so
so
much,
much,
sir.
Thank you.
Thank you.
Thank you so much, sir.
Yes,
Thanks.
definitely. Bye-bye.
Thanks.
Bye-bye.
Bye.
Thanks. Bye.
Bye, sir.
Bye-bye. Bye.
Bye.
Thank you. Bye-bye.